Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review or preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. If you do have any questions during the webinar, please do ask them along the way in the questions box, and I'll hope to get to those questions during the webinar, or at least at the end. Our goal really is to break down all the market jargon and complexities that you will read about. So if you do have those questions, please do ask them, however big, small, on what you're looking at, what we're talking about, or the setups we're looking at, or the setups you're looking at. So please do ask questions along the way if and when I'll have time to answer those during the webinar. Okay, those are the disclaimers. First up, we'll just check out, I'll just run through what we hope to get through in the next 30-40 minutes or so. Initially, we'll just look at how markets are shaping up. We'll look at US stock indices. Before then, looking at all the key data from last week. That is essentially the UK CPI inflation data, really important for the Bank of England, and pricing, big move that we saw in sterling and in rate expectations in the UK because of that data. So we'll look at that in detail. We'll look at the RBNZ meeting from last week as well, slightly more hawkish than expected. So that gave a lift to the Kiwi dollar and really priced out rate cuts for this year. And then briefly touch upon the PMI data from last week as well, important for or as a leading indicator. So we'll touch upon that before then looking at this week's main events, which are again inflation data, but for the US in the form of the PCE data. That's the Fed's favorite inflation gauge, and then Eurozone inflation data as well, which is out both on Friday. So we'll just touch upon those and preview those and look at all the associated currency majors. So sterling against the dollar, Kiwi against the dollar, Euro dollar, and the DXY chart as well. Okay, firstly, markets really negative sentiment really is being shown up in Asia. Actually kicked off this morning. Hong Kong equities dropping 1.8%, the Nikkei down 0.8%. Futures as well, US futures in the red, I think, last time I looked. For equities, we get Salesforce earnings out tonight out of the US after the closing bell. They're expected to show solid revenues and improved profitability. For currencies, the dollar is, well, reversed earlier losses yesterday as Fed speakers and data really continue to lean slightly hawkish. We had US consumer confidence better than expected. And then overnight just gone, we had Aussie CPI data, inflation data came in hotter than forecast. That helped lift the Aussie briefly initially as the chances of rate cuts for this year really were reduced and cut out. Fixed income, so that is bonds, yields, they've been the big mover really this week. And if we just bear with me 1 second, I'll firstly pull up a chart. Which is the US 10-year yield, which may be a big issue for markets because it's broken higher. So you can see we don't normally touch upon this too much, but I just want to double check that you can see that, which you can. So yes, we had a big move yesterday through 4.5% on the 10-year yield. The 10-year US Treasury yield is seen as a global benchmark for borrowing costs. That's why we look at it. That's why markets concentrate on it so much. So much is priced off this 10-year US Treasury yield. So good always to just have a look, just see which direction you think it's going, because then that governs other asset classes as well, stocks and the dollar for sure. Rate expectations obviously. So here you can see, yeah, just yesterday this break higher, quite a strong break higher through 4.5%. The blue line's the 50-day moving average, and we've just moved higher now, potentially going up towards this sort of high region around 4.7%. If that happens and this bullish momentum picks up in yields, so bond prices selling off, yields going higher, then potentially that will underpin support for the dollar and potentially have an impact on gold and also risk assets, so stocks for sure. Really reasons for that big lift in yields for sell-off in bonds, really due to concerns over supply and then obviously inflation on that confidence number. As for commodities, gains were led or are being led by silver, coffee, and crude oil, while gold's 3-day bounce actually stalled. And there's a case in point because yields have gone higher. So you can see this 3 days of consecutive gains, not massive gains really, and only clawing back some of that loss from Thursday. But of course, Wednesday as well was a big seller from that previous all-time high at 24.50. So we're selling off now as those bond yields go higher, which makes complete sense. Silver, that has been outperforming gold, surged back above $32 near 11-week highs, and as I said, continues to outperform gold. As for stocks, if we just look at the major indices, we just go to a week, you can see consecutive weeks of gains. We're into the 6th consecutive week of gains from these lows below 5,000. Kind of got a doji candle there from last week, so that denotes indecision really at the highs, and you can see that bearish engulfing candle, especially from Thursday last week. We printed a high, all-time high at 53.41 in the S&P 500, but then closed near the lows. Buyers sort of stepped in around that 52.64 level, that previous high that we've got here. So we're just holding above that support level, very important, I'd say. If we do lose that, which is that low from last Thursday sell-off, then potentially we go back down towards 5,000 or so, or at least 51.46, which is that swing low really, with the 50-day moving average at 51.76. Otherwise, if we can stay above this and that acts as support, the 52.64, then certainly we can challenge 53.41. Although you can just see that momentum has tailed off, that bullish momentum, as we sort of got slightly into overbought territory and we've just pulled back. So whether that's just consolidation before look higher, potentially that could be the case. And the Nasdaq certainly been leading the way this week, at least. Yesterday, Nvidia up nearly 7%. Not on anything specific we couldn't find, but just obviously after their numbers from last Wednesday, blockbuster numbers, all round really, even beating expectations of the best expectations as well. So you can just see again that sort of Thursday sell-off, but then tech leading the way, pushing up. It was a record closing high yesterday, and then obviously we're looking at the all-time highs again at 18,907. That's in the Nasdaq 100. The Dow, though, that's struggling, defensive struggling, and you can see the big sell-off Thursday, and we've continued lower. The blue line, that's the 50-day moving average at 38,905. And we're then on the halfway point of this move higher. That's the 38,848. So interesting. Probably want to put out the next fib level or fib levels below potentially. So you've got 38,559 and then 38,146, the next fib levels there of this move lower if it does indeed move down. Otherwise, the 50-day moving average could possibly act as some support, along with, as I say, that 50% halfway mark of this move higher, around 38,848. Okay, let's now look at last week's main data points. Firstly, UK CPI. Just double check you can see that, which you can. Yeah, so that came in hotter than expected, but obviously the headline numbers grabbed attention simply because they dropped sharply. They hit levels last seen in July 2021, but they did come in hotter, as I said, than expected. 2.3, the headline, 0.2 higher than the expected 2.1. Similarly, core as well, that printed it lower, but still rising at 3.9%, but that was above expectations of 3.6%. Even though it was lower than the prior 4.2. We've got in here the key services inflation data. That is key for the MPC, the Bank of England, the single most important indicator really for them. That came in very much above expectations, 5.9%. So higher than the 5.5 estimates, and also higher than the bank's own forecast of 5.5% as well. That is a serious issue for the Bank of England, and why you saw the markets move so strongly. Economists really, they do point out that this has had the potential to be highly volatile owing to a multitude of annual price hikes that kick in at the start of the financial year in April. And we saw a very similar surprise last April actually as well. There were actually spikes higher in social rents, and that seems to have explained much of the surprise, the upward surprise really. And most of these are one-off actual price adjustments, so potentially we can't infer going forward that this is a problem for UK inflation, as I say, in the months ahead. And in fact, actually this time last year, markets kind of wrongly inferred that from the April figures, which were skewed higher, there was a more serious situation in inflation, but then ultimately the disinflation process carried on. So it would be possibly a mistake to infer that again. And May figures generally are meant to be more predictable, so economists say. More broadly then, expectations for headline are to slip actually below target, below 2% target in May, and probably then float around 2% for the rest of the year, possibly an uptick. Bank of England thinks they possibly move a few tenths higher than that 2% level, but they should really be helped by likely further falls in household energy bills in July. And then we also have the potentially for more limited disinflation in food and core goods. So here's a chart just of those falling prices that you can see, but just not as cooler as expected, just on those main numbers. So for the Bank of England figures, probably not a game changer, these figures, certainly because also we get another inflation print, another inflation report before the June Bank of England meeting. But certainly markets did react and cut the odds of a June rate cut from sort of 50-50 down to less than 10%, I think now. And that's really, a reaction to the hotter numbers overall, and that services inflation number that we've highlighted. As well, you have to think the bank is still really quite divided, but then also we do get very few media appearances by internal committee members up to the meeting. So it will be tough to know which way the votes are going, but at the moment markets certainly thinking no June rate cut now, and the odds of an August rate cut, which were very high before this data, now sort of halved, I think, to around sort of 40% or so for an August rate cut, a touch higher actually, around 50-50 now for that August meeting. If we just look at cable, so that is sterling against the dollar. Let me just bring up the chart. Certainly sterling had a decent run, definitely decent run since dropping below 123 late April. You can see really strong move up to sort of 128 yesterday we touched, but just pulled back lower, and certainly we're just getting not really overbought, but getting closer to overbought territory. Probably that 128 touched us around 70 on the daily RSI, so slightly overbought, nothing major, but a decent run, so potentially some pullback in the offing as we just pull back from that sort of slightly ominous candle there. You can see 128 print the high, but then we close near the lows, so potentially a bearish candle pattern there. Otherwise, we've got support. Take that off actually, but we've got probably support around 127. You can see this here where we sort of oscillated sideways, so that's very strong support, I'd say, and then sort of 128 the upside level for potentially then a look at the year high at 128.94 from March. Okay, that's cable. Let's now look at, well, before we look at Kiwi dollar, actually, we'll just check out firstly just the graphic I have of the policy rate against, just checking, you can see that actually, yeah, policy rate against the inflation rates. The RBNZ, yeah, they left rates unchanged. The official cash rate, the OCR, unchanged at 5.5% last Wednesday, widely expected. But inflation has remained stickier than expected. So the RBNZ's rate path was actually revised higher. So the updated path now implies a 50% probability of another 25 basis point rate hike during the second half of this year, while the first cut is now not expected until Q4 2025. That's a huge contrast really to money markets, which had been banking on a November rate cut being fully priced. So not till the end of sort of next year now is when the RBNZ see a rate cut. Also the long-term nominal neutral rate, that was also revised higher, 25 basis points to 2.75%. Yeah, hawkish in the main, and those headlines were hawkish, but then the accompanying sort of communication was slightly less hawkish. The RBNZ saw capacity pressures and labour markets easing, while imported inflation has also moderated. Slowing hiring and recovery and immigration actually contributed to a sort of balancing of labour markets, and that is potentially as well cooling wage growth pressures. All in, no monetary policy, they said, still needs to remain restrictive to ensure inflation returns to target within a reasonable time frame. And if we just look at the Kiwi against the dollar, which is here, you can see that big move on Wednesday, then up to 61 from sort of where were we, the lows, and the 200-day moving average is the black line at 60.41. So broke through that quite nicely. You can see that sort of bullish consolidation really tracking sideways, and then bang straight through that sort of 60.41 level, the 200-day moving average. Strong move higher, then tracking sideways again, and then another push up on Monday. Remember, that was in thin liquidity really with holidays in the US and UK, but then we continued up again, slightly bearish candle printing at 61.70, but then just closing on the lows. So just watch out for that. We've got some fib levels in here, which are of the Q4 rally. So 61.41, that is sort of 38.2 level. If we do break that high though, the 61.70, then potentially we go up to here, these highs here around 62. Otherwise lose this, then certainly decent support around 60.71 and 60.71 and 60 sort of 80 area. So yeah, interesting move in Kiwi dollar, but obviously a lot dependent on risk sentiment as well for the Kiwi. I said we'd touch on briefly PMI data from last week. That was generally better than expected across the globe. Again, I'll just show you a nice little chart that we have here, which is from Reuters, and just showing you sort of global PMIs. So all the different countries, and then the different colors, blue denoting below 50, the reading, which means contraction, whereas the sort of brighter redder numbers are above 50, which denotes expansion. So just improvement that you can see. Obviously blue most of last year in the Eurozone, France, Germany, Australia, and the UK. The US sort of just around 50, you can see back in August, September, Japan 50, but then you can just see more red now happening through this year, through January, through to April. Some decent numbers. Eurozone, just to look at briefly, PMIs, services, that was unchanged actually, so slightly disappointing, whereas manufacturing rose more than expected. That meant the composite was above 50 for the third consecutive month. So really pointed to momentum really gathering in the Eurozone economy. Importantly, as well, price index, that's what policymakers look at. The service sector price index ticked down actually at its lowest level in 3 years, although it's still above the historical average. That's certainly good news for the ECB, although against that we should say we did get wage growth numbers released on last Thursday for Q1, those negotiations rising by 4.7% from 4.5% in Q4. So certainly that was balanced against these good numbers really. And the service sector price index actually coming down, but wage pressure is certainly still substantial in the Eurozone, and potentially an issue going forward for the ECB after their June rate cut, which is pretty much nailed on. We'll look at Eurodollar shortly. UK PMIs, they were also fairly decent, although they did surprise marginally to the downside. So manufacturing rose actually into expansionary territory, 51.3 from 49.1. So that was encouraging. But then services and the composite remain they remain above 50, but they did drop to 52.9, 52.8. From sort of 54.7 and 54.0. So a slight worry there, but generally overall probably good news for the Bank of England, with businesses reporting softer increases in average selling prices as well. US flash PMIs, they surprised to the upside actually as well. They were driven by stronger services activity, with the composite really remaining firmly in growth territory. Okay, let's move on now to US inflation. That is the PCE number. So just to highlight here, it's the core PCE number which everybody is focusing on out on Friday. This is the Fed's favored inflation tool. You might read that a lot, and that's simply because the CPI number, that's based on survey data from consumers, but instead this adds reports from businesses as well. So it's broader in coverage than the CPI data, and then the Fed's view really better represents spending patterns of US businesses, US consumers. So yes, the headline PCE number, that's seen rising 0.3% in April, so unchanged, and also the annual rate expected to be unchanged at 2.7. But everybody looks at the core number, so that number is seen also rising actually 0.3%, possibly a touch lower now. I think some estimates now sort of bring it down to 0.2%. Previous was 0.3, and then the annual core PCE number seen unchanged at 2.8%. Just looking at the other inflation gauges anyway, headline CPI, if you remember, that cooled actually, so was softer than expected in April after those 3 months of ticking higher, while the core CPI metric, that saw the smallest increase since December. And then also PPI data, producer price index data, that's important for the PCE. That surprised to the upside actually in the month, but internals, so components that feed into the PC data, if you like, they were relatively constructive. Couple of other points to note on this data. I think 0.36% is the average for the prior 3 months. So potentially we're looking at decimal places. Don't want to get too detailed into this, but possibly a sort of 0.26, 0.27 number would be constructive for markets. So just watch out for that, as well as that sort of single decimal place number, which will be released. Interestingly as well, Goldman Sachs investment bank, they estimate that the market-based core PCE index, which has been referred to by Fed Chair Powell, has been quite consistent with a July or an earlier rate cut, because that pace is around 0.18%. And as I say, that pace would be consistent with an earlier rate cut, but we shall see. In general, though, that said, of course, we have had pretty much a hawkish set of FOMC meeting minutes. We've obviously had Fed speak, which has been relatively hawkish, just saying that they have time to wait to see inflation coming down, and therefore higher for longer is probably most appropriate at the moment. For Fed pricing as well, then if we look at that, money markets really pricing in no easing at all at the June meeting, June 12th that is. then really a sort of less than a 50-50 chance now of a cut in September, and then really a total of just 30 basis points now for the whole of this year. There's probably around a 70% probability of a rate cut, 75% probability of a rate cut in November, and then one priced in for December. So only 30 basis points in total. So that's 25 basis point plus sort of 20% chance of a 25% chance of one more rate cut this year only. If we look at the DXY chart, which I'll just pull up here, you can see is kind of the opposite of Eurodollar, which we'll look at shortly, because if you remember, the DXY has around a 56-57% weighting of the euro in this index. So you can just see, interesting, we've got the 200-day moving average at 104.41, just below current prices. That's that black line, and then we also have this upward trend line really, which is tacked a couple of points, so pretty relevant, and that's around there as well, 104.41. So that's decent support. Just below there is that fib level at 104.26. So a strong zone of support for the dollar. Potentially, and then above we have resistance around probably the 50-day moving averages, the previous highs around just above 105. So interesting levels for the dollar as we head into this inflation data, the PCE data that we've talked about. Okay, otherwise we'll just check out the Eurozone inflation data as well. Bear with me 1 second. I'll just pull up the charts showing you that, showing you really headline, which is the red number. Blue line is core number. That's probably the main number that ECB policymakers look at. And then you've got obviously the benchmark and inflation target around the 2% level. Eurozone expectations for the headline seen actually rising from 2.4 to 2.5%, and then the core set to hold steady. The last release, actually, the headline was unable to make much progress. It remained at 2.4%, really due to an increase in food inflation, and then only a modest decline in energy inflation, while the core really fell 0.2 from 2.9 to 2.7% due to moderating services inflation. This time around, headline may tick up on the back of higher energy prices. Core probably pretty stable. Worth noting though that the release has come in the context of that those wage metrics that I've just talked about, firmer than expected, and as well those PMI data figures also better than expected as well. For the ECB then, what does it mean? The June rate cut is fully baked in still, but it's really after that which will be key, and so this data potentially key for that post-June rate cut. Policymakers, they have been pretty vocal recently, of course, heading into ECB week, which is next week. And really the odds of more rate cuts similar to across the globe really have been cut as well in the last few weeks. We've sort of come down from 75 basis points only 2 weeks ago. That's total amount of rate cuts this year, down to around 58 basis points now. So 2 and a bit cuts priced in, around a 32% chance then of a third rate cut. But it is the second rate cut which has been pushed out from sort of after June towards sort of September and beyond. If we just look at Eurodollar then. Just to show you the chart, you can see, yeah, just sort of got to just below 109, 108.94 middle of this month, popped up to well, just below 109, 108.89 yesterday, and we're just sort of slightly lower on the day today. You can see first levels, probably these levels here, which are sort of 108, just above 108, and then you've got the 200-day moving average and the 50-day moving average at 107.87, 107.72. Otherwise, upside level 109, sorry, 108.94, 109 sort of level tallies with that swing high there at 108.85 as well. So that is euro dollar. Finally, actually, we'll just touch upon, sorry, we could have touched upon it earlier, but look at Aussie CPI data actually. That for April stood at 3.6%, so higher than expectations of 3.4%. It's the second month in a row where annual inflation printed an increase, extending a potential bottoming out process that's been going on since really December of last year. Also underscores the need for really the RBA to remain vigilant on the matter, even as yesterday's retail sales actually suggested slight consumer sort of weakness. The upside surprise in the CPI data, just checking that out, actually was sort of in part driven by increases to petrol, health and holiday costs. The CPI excluding volatile items and holiday travel actually remained unchanged at 4.1%. And then the core reading, well, in February it hit a 2-year low at 3.9%, and then that's been creeping marginally higher since. The Aussie, though, actually having sort of popped higher. Here you can see it popped higher up above 66.60, but then has fallen really on the back of the strength of the dollar, and as well futures now showing, US stock futures actually showing quite solid losses now. Nasdaq off 0.6%, S&P off 0.56%, the Dow off 0.55%. So stock futures down in the US, adding to sort of buyers' bids in the dollar, and then seeing the Aussie dollar fall now after popping a little bit higher on that CPI data, interestingly enough. For levels in the Aussie, you can see the halfway point of the Q4 rally again, 66.16, potential sort of resistance you can see, and now possibly support as well around that area. If we do lose that, then we go down to the next level, which would be around the 50-day moving average of 65.59. Buyers, though, possibly holding that support level that will then look towards 67, and these highs here just below, yeah, just around 67, 67.14, 67.09 potential upside levels in the Aussie. Okay, we will wrap it up there actually. Great having you on the call. Really do appreciate you sticking around. I don't see any questions, so that's all good. We will speak to you in a few weeks' time. Take care.